It's 10:30 now, Peter. So I will let you have the words and presenting your company.
Okay. Well, thank you, Michael, very much. So my name is Peter Ramsey. I'm the CEO of Taaleri PLC, and I'm very glad for this opportunity to present Taaleri at the Green Transition Seminar, as several of our business units are directly part of this transition. So I've been the CEO of Taaleri since December last year, and my background is in the financial industry, where I've been for over 30 years. And I aim to shed light on Taaleri and our activities, and also to increase the understanding of our business and why we can succeed on our chosen path. Taaleri was founded in 2007 as an asset manager, but we sold about 18 months ago our wealth management business to Aktia, a local savings bank, and we struck a strategic distribution agreement for Tier 2 and Tier 3 customers in Finland. And we chose to focus on our private equity initiatives, which I will tell you in a minute. But Taaleri, in a snapshot, the market cap is slightly over 250 million euros. We have roughly 100 employees, and we have assets under management of 2.4 billion euros. And if we look at our headline here, impact through alternatives, for us it means that we mainly do it through private equity funds. And the business lines that we have are, for first and foremost, renewable energy, which means solar and wind mills in industrial scale parks, bioindustry, and then we also have a real estate business. I will come back to these in a while. But we have observed that in an escalating manner, capital is filtering through to tangible projects that have impact in our society. And that is actually what we do, tangible, real life projects. So many things are dependent on timing, and we strongly feel that we have a lot of tailwind for our businesses right now, and also an acceptance among investors to take part of this journey. One can say that the green transition is at the core of our business and basically defines what we do today. Now, moving on to our strategic roadmap. If we look at the left-hand side here, it says focus, and we are focusing on impact and renewables. And this, of course, after the sale of the wealth management business. So the idea here is that we think that we can build from Finland as a base a company that can have global reach. We're trying to build critical mass, and that also filters into the next headline here, growth. So for us, as I mentioned, we feel there is tailwind in what we're doing, but the tailwind also hits everybody else, even our competitors. So we believe we have to build critical mass so that we can attract talent and retain talent to build our position in the market. Growth is also important when it comes to size, because, of course, we're dealing with a lot of sub-suppliers and companies in our procurement chain. And as we grow, our importance for them also grows. And thus, we believe that we can do this with a high quality and then become a more significant player in the space. Finally, we move to the third headline, returns. Now, of course, we are managing money for our investors. So a prerequisite for our success is that we manage to get the returns that we aim to do for our investors. Then we can raise new funds and have more fees that then eventually trickle to our shareholders in the form of fees and also performance fees if we are successful on our investing activities. What we're trying to do is we're trying to build on our knowledge and expertise that we have already gained and scale it to a new dimension. There are several megatrends that are affecting Taaleri's business environment. One could say there are 4 or perhaps 5 that are the ones where we are in the epicenter. So if we start with climate change, it is quite clear that the ambition is to reduce carbon dioxide from the atmosphere. And of course, our renewables address this issue head on. Also, our bioindustry initiatives are working with this issue. Now, as a new dimension, if we look at geopolitics, which might be a megatrend here as well, we can say that the war that the Russians started in Ukraine is definitely something that also is visible right now in the activities we're engaged in. Electrification. We all know that there is an ambition to electrify the world, despite, of course, the fact that we might have very high electricity prices this coming winter. That is still an ambition, and of course, our renewable business caters to this need. If we look at changing values, we know that consumers over time do change their values, and what has been very evident for the recent years is that consumers want to know what their carbon footprint is in any service or product they use, and they also want to know that these products or services are sustainable. And of course, our bioindustry is very much in the core of this. Now, finally, urbanization. We concentrate on residential housing funds, and of course, that is then visible in the fact that the urbanization is still taking hold. This is a picture that shows the assumption of electricity consumption for the next 80 years. I think this is the International Energy Agency that has sort of produced this chart. And of course, from our perspective, the interesting part is the light blue stake in the pie here, which is growing. You can see in this chart. And that is, of course, renewables. So the proportion of renewables of the electricity generators is going to grow, as well as the fact that fossil fuels will be exchanged or will be partly going into non-fossil fuels. Now, if you look at the red line, it definitely surpasses the production here. And that is eventually a question of productivity gains. So one of the biggest drivers in electricity consumption and enabling that will be productivity gains that we will see in the future. So from megatrends to more concrete and tangible market trends. For us, the tailwinds in renewables and bioindustry, I already mentioned them. But of course, there are concrete things that are driving this. And one thing is, of course, in the EU, European Union, the taxonomy. And then lately in the US, we had the Inflation Reduction Act, which not only gives tax credits, but there was also an ambitious goal to reduce carbon dioxide by 40% until 2030. Then the second point from the left is security of energy supply and energy reliability and the energy independency, as well as the breakaway from fossil fuels. Now, this has been accelerated by the Russian invasion of Ukraine, and I think it is a topic that we will come back to both as investors and also from the political side in the coming years quite frequently. And this is already visible in what we do today. So that is a thing to bear in mind. The third picture from the left here says rising allocation into private asset classes. And on our sort of plate, what we can offer the private asset classes is, of course, diversification and then access to investments that perhaps the liquid markets do not offer for the time being. And then finally, over time, we know that savings and wealth grows, perhaps not as we speak today, but over time. And of course, for us, that is really important because investors' money is the raw material for our private equity business. So we say that we strive to be a Nordic forerunner in alternative investments, focusing on sustainability. And this is truly our goal. We have a very skilled and ambitious personnel, and this is a prerequisite for our ambitions. And our personnel is our most important resource. There is a lot of footwork we have to do, and we need the right culture. And we are really keen on nurturing a strong corporate culture. And one of our values tell the level of our ambition, and that value is dare to succeed. These are very important numbers. If we start on the left-hand side on the top, we say that 59% of our assets under management is taxonomy eligible. And then underneath, there's 75% of our AUM, assets under management, is either Article 8 or Article 9 labeled products. Now, what does Article 9 funds stand for? It says here that the fund has sustainable investment as its objective. Hence, all investments need to contribute to an environmental or social objective and do no significant harm to other sustainability objectives. And all our wind and solar funds are Article 9 funds, as well as our latest bioindustry fund, which we just had a first closing this spring. And then Article 8 funds says that the fund promotes environmental and social characteristics. 2 of our real estate funds are under this category. Now, if we move to our business lines and start with Taaleri Energia. Taaleri Energia develops and invests in utility-scale wind farms and solar plants. It manages assets throughout the entire life cycle. Now, this is important to note. So our team, which is one of the biggest in Europe, it's over 40 persons, they have an end-to-end expertise in whatever they do. So it's everything from project development, deal sourcing, technical due diligence, project financing. They execute transactions, they construct the parks, and they operate them. Eventually, they might sell them, but these are long-tailed projects. In total, we manage 2.8 gigawatt of wind and solar assets in Europe, in the US, and in the Middle East. And our assets under management is 1.3 billion euros under the renewables. And the next big event for us will be to raise our next fund, the SolarWind 3, which we will probably start the fundraising very soon. Moving over to our bioindustry business. We consider us a European forerunner here. And Taaleri Bioindustry develops and invests in industrial scale plants that enable the growth of bioeconomy sector globally. We basically have 3 activities here. We've just raised had our first closing of our first bioindustry fund at 80 million euros. The hard cap for the fund is 120 million euros. And this is a growth fund for proven technologies that we help scale. It basically means we help them build factories so that they can grow the business and sell their products to a larger audience. Then we have also invested in a biorefinery in Hamina in southern Finland. We own 24% of Fintoil, which is just about to start its production of tall oil. That is an ingredient that you use to eventually produce biodiesels. We have also commissioned the build of a bio-coal factory in the center of Finland, in Joensuu, and this will take 12 to 18 months to complete. Our team has a strong technical know-how and also industrial transaction experience, which is very important for the activities we do here. And the team will grow as the assets under management grows. Moving over to our real estate operations. We specialize in real estate fund investment and asset management, and we manage today 9 closed-end real estate funds, and we also have 4 real estate mandates. The total value of the properties under our management is about 800 million euros, and we have 14 people in this team, and we typically concentrate or do these vintage housing funds within the private equity space. And the latest fund, which we had the first closing in late last year, was housing fund number 8. If we look at the business logic of Taaleri, we can see that on the left-hand side, we have the private asset management business, the ones I just mentioned, renewable energy, real estate, and bioindustry, where, of course, we share best practice, we share the administration, to be effective there, we share knowledge, and then we also have our distribution split so that Aktia takes care of our tier 2 and tier 3 distribution in Finland, and we take care of the tier 1 and the international distribution ourselves. On the right-hand side, you can see what we call our strategic investment, that is Garantia, our credit guarantee business, which is actually very profitable and is and has been financing our private equity build-up. We have set out long-term financial targets. There's 3 of them. One is the growth in continuing earnings, which we say that should be 15% over a longer period of time. Now, in the case of continuing earnings, these are mainly the management fees and as well as the net guarantee premiums Garantia earns. But when it comes to the management fees, they are, of course, lumpy to the extent that if we launch a new fund, then management fees will rise, can be quite substantial. And on the other hand, if we sell down a fund or exit a fund, then, of course, to the same extent, management fees will fall. So we say 15% long-term target is the growth for our continuing earnings. Then on the operating profit, our ambition is to have an operating profit that exceeds 25% over the long run. And then we also say that our return on equity for our shareholders should over the long term be 15%. We have also said that we distribute at least 50% of our annual earnings as dividends to our shareholders, and eventually all surplus capital that we don't need to build our business. I mentioned to you in the beginning our market cap and our assets under management and our personnel. But if we conclude by saying that last year our income or revenues were slightly under 70 million and our operating profit was slightly under 31 million euros. Down below in this chart, you can see how our assets under management are split, and you can see that roughly 55% is renewable energy, 36% is real estate, and then it's split pretty evenly between bioindustry and our old legacy funds that we still operate. I typically say that 1 quarter is a very short period for our type of a business consisting of private equity funds and long-dated credit guarantee business to sort of draw any conclusions. So thus, I want to show you here our rolling 12-month income and also operating profit. So if you look at the left-hand side, we have the continuing earnings. The dark blue bar shows the continuing earnings, which are management fees and net premiums earned in our credit guarantee business. And the light blue bar is then other than continuing earnings. And that is typically performance fees and investment income. And as I said earlier, if there's a big shift in, let's say we launch a new fund, then of course the continuing earnings can make a step change up, or if we exit a fund, it can make a step change down. And then on the right-hand side, we have the operating profit for previous 12 months, which shows a 35% operating margin for the last 12 months as we speak. That is the end of my presentation, and I guess we are open for questions.
Yeah, Peter, thank you for the presentation. Just on top of my head, and there's also a question out here, and I talked about this taxonomy and promised you that it will be pushing a lot of money over in your industries, but actually, is that true, or how is your expectation? I could see that a lot of your investments were actually under the taxonomy. So do you expect that creating new funds that will be under this regime, there will be a lot of more interest, simply money being pushed over there from investors?
Yeah, I think we're going to stick to our guns in the sense that we have chosen the sectors we are active in. And so within those sectors, of course, as I mentioned, the SolarWind 3 fund will be launched and raised here during the fall. But of course, a fundraise takes more than just 6 months. It typically stretches up to, can be 18 months. But of course, we have our own ambitions on the size of that. We've said that it should be double the size of the previous fund. But how does that filter through from a taxonomy perspective? I think it does in the sense that, of course, we sort of at least feel that investors are much more willing to talk to us because we've been around for a while. So it's a little bit about brand building. And then, of course, people are looking at the quality we're doing. So it's a bit different when it's private equity than if it's a listed fund, because in a listed fund, the liquidity is much shorter, so you can sort of go in and out. Here, once you make a commitment, you're really stuck with us for a long time. And of course, we want the right kind of investors who want to do that. But I would say definitely it filters through, at least in the form of interest. But if we look at our bioindustry fund, which we raised and had the first closing just before summer. I think one notion is quite clear there, that it's a first-time fund, and yet we hit the target size at the first close. And I think that sort of is a good demonstration of the fact that there is traction.
Perfect. And then a second question, when I speak to the different developers of this type, as you also are, the swings in the input factors and the output factors are enormous, meaning that the manage the risk right now is very, very hard. Any thoughts on this point, looking into a new fund? How do you actually manage, long-term electricity prices with the building cost right now? I guess it's you need to kind of widen your expected outcomes of this.
Yeah, I mean, that's of course sure that, when you model these things, you have to bear in mind, it's always been so. Now, of course, just the volatility of the modeling is pretty tough because, where do you put down your boots? But I think where we differ, if we just take, the way we run the business, so where we differ is we do project development. So that means that we build a pipeline of projects well in advance before we start deploying the money. And I think that is a competitive advantage right now. But I see there's a question on PPAs here as well. And if we move straight to that. So, of course, when you sort of historically have been financing these, there's, of course, an interest from the banks to see that you strike longer dated contracts. And I would say that I think that's not going to change as such. But we, of course, have to be very cautious about counterparty risks and how we manage those. And so, that's why we do industrial scale businesses, and our counterparties are then, established big players. On our own behalf, of course, we have a diversified portfolio, so it's not like a one-hit wonder. We have several projects and several farms or parks in all our funds. So it is also, from our perspective, how you diversify that over geographies and over technologies. But it won't take away the fact that right now the markets are pretty crazy. And, I'm sure it's also on the other side who wants to do a deal at a very high price right now. So it might be that when we model these, then looking at the outcome, in the end, it probably will be the same, but you have to have more margins of safety in your modeling as such. But if you turn the pie, and you sort of think of it as an opportunity, it actually also opens up opportunities. And as you become a bigger supplier of energy in various geographies, then in a way, you're sort of, at least to some extent, de-risking yourself, because you're not dependent on one geography and one market and one spot price, or spot is maybe the wrong term, but one future price in a single market. So I think that puzzle is something that we've thought about a lot, and I think at least the way we address it, I think is very sensible.
Then there's a question here about the rising interest rates. You need to put a premium on top of for taking the risk, and in the same while, I guess a lot of people is moving into those sectors, maybe pushing down the kind of IRR you can get on green projects. There will be a lot of them, but a lot of is also crowding in. Any thoughts about that environment, when you need to close funds, or whether the people in your funds are asking those questions?
I think generally, if you look at the interest rates, it's probably, we don't differ from anybody else. It's the same input factors for all the players. That's the starting point. So I think, we're more than compensated, of course, now by the rise in the price that we can sell at. So I think that is sort of one of the notions. It also stretches the whole procurement chain. I mean, if suddenly everybody is moving into a space, there's just a finite amount of equipment you can get. So I think there again, how we look at that is that if we grow, we become a more critical counterpart, and then we have a big sort of a bigger weighing in that chain. But I think eventually, or the situation right now for us is, the way we look at it is, starting off, we have hedged most of our interest rate risk anyhow, and in the new projects we will continue to hedge, and then that will be sort of just part of the equation, which then boils out in the IRR we look for. But I would stress that the difference for us is that we have a pretty good 14 project portfolio already at our disposal, which is a big difference to those who just go out and raise money and then start hunting those projects.
Perfect. And then there's a final question on the PPA. Are you seeing rising prices or the future expectations of higher energy costs in the very long run? As they still not going in or zipped over to the PPA agreements? I don't know whether you can answer this question, but
yeah. So actually, yes and no. I mean, for sure. I mean, they're going up, but and that's the point with the interest rates, and they're more than compensated by that. But then, of course, on the other side, who wants to strike really, really long contracts at high prices? So I think that sort of element also affects it. But I don't really have a good answer to you on that, because when we sort of model, we still think that we can make good for the return promises that we have made to our investors.
Perfect. Thank you, Peter. Time is running out. So thank you for taking us through the presentation and answering the questions. So may you have a nice day.
Thank you very much. Thanks for having me.